Welcome back to the Deep Dive. We're here to break down the latest earnings calls, get you the key info. Today, it's HF Foods Group, their Q2 2025 results. Now, they're a big player, nationwide distributor, Asian specialty foods, but it's a tough space right now.
Definitely a challenging backdrop. You've got inflation, tariffs popping up, especially on seafood imports, shifting consumer spending. It's a lot.
Right. So the question hovering over these results is, how much is just market forces and how much is them actually executing well operationally?
Exactly. And that's what we're trying to unpack for you today. We'll look at the headline numbers, which were, frankly, pretty surprising, then dive into the big internal stuff, particularly that massive ERP system rollout they just finished. And finally, try to square management's, let's say, optimistic long-term view with how the market reacted, which was, well, not quite as enthusiastic short-term.
Yeah, let's jump right into those financials because they certainly caught attention initially. There was that nice after-hours pop. They hit record net revenue, $314.9 million. That's up 4.1% year over year. And yeah, it definitely beat the consensus estimates.
And the leverage, that was the really impressive part. Record adjusted EBITDA, $13.8 million. That's a jump of over 31%. Year over year. Huge increase.
Wow, 31%.
Yeah. And net income followed, up 117% to $500,000. So, bottom line looked good too. Both GAAP EPS at 2 cents and non-GAAP at 12 cents came in ahead of what the street expected.
Okay, but what about margins? With costs going up everywhere, how did they defend their gross margin? It actually went up slightly, right? 13 basis points.
It did, up to 17.5%. Management said it was a mix of things. Higher volumes helped definitely, but they also talked about improved pricing discipline.
Pricing discipline.
Particularly in their big categories, meat and poultry and seafood. They also mentioned using inventory management more strategically, maybe to buffer against some of that tariff uncertainty.
Okay. But wait, you mentioned earlier they started seeing softer foot traffic near the end of the quarter.
They did. That's a key point we'll get back to.
So is that margin expansion sustainable? Is pricing discipline just code for, raising prices right before customers potentially pull back?
That is the million-dollar question, isn't it? It's the core tension here. Management seems to be betting heavily that internal efficiencies, the savings they can generate themselves, will offset any potential slowdown in customer traffic.
And that brings us squarely to the operations side, the big story there, this new ERP system.
The bedrock, really. They finished rolling out this new, modern ERP application across the entire network on May 1st.
Now, for listeners maybe not totally immersed in operations tech, explain why rolling out a full ERP system is such a massive undertaking and such a big deal for a distributor like this.
Think of it like the company's new central nervous system. ERP, enterprise resource planning, it connects everything, sales, inventory, logistics, purchasing, onto one single unified platform. Management explicitly stated this is designed to unlock, quote, breakthrough levels of efficiency.
Breakthrough levels, so it's about visibility, control.
All of that. Better inventory control, knowing exactly what you have where, better pricing discipline because you see the whole picture, and crucially, centralizing purchasing power. Buying smarter, basically. That translates directly to cost savings.
And are we seeing those savings show up yet? I mean, it only went live May 1st.
We're starting to see the first hints. The clear sign this quarter was in their distribution, selling, and administrative costs, DSA.
Okay.
As a percentage of revenue, DSA actually dropped. It went from 16.5% a year ago down to 16.2% this quarter. It's not huge yet, but it's the first tangible financial benefit appearing.
And there's more to come, presumably.
That's the plan. Management said the next phase involves rationalizing the sales force, basically using the system's automation to become more efficient, potentially reducing headcount costs over time as the system beds in.
Got it. So big digital investment paying off or starting to, but they're also investing in physical infrastructure too, right? The warehouses?
Correct. It's not just digital. They're upgrading physical capacity to enable more growth, especially cross-selling.
Like the Charlotte facility.
Yeah, renovations there are nearly done. And then there's the big one, the new state-of-the-art facility they're building in Atlanta.
What's the significance of Atlanta?
That one's key. It's going to double their cold storage capacity in a really important region. What that unlocks is the ability to sell way more frozen seafood to their existing customers all along the eastern seaboard. Customers they already have, but who couldn't buy the full range before because HF Foods just didn't have the freezer space.
Okay. So it's about selling more to the customers they already serve, increasing wallet share.
Precisely. Maximizing revenue from the existing client base.
Okay, so we have this really strong internal story shaping up, efficiency gains from the ERP, expansion from new facilities. Sounds good. But then there's the other side, the macro environment. They couldn't totally escape that, could they? This is where the guidance comes in?
No, not at all insulated. Management was very clear. They saw lower exit velocity, as they put it, less foot traffic towards the end of Q2, and that trend continued into the start of Q3. It mirrors the broader consumer spending pullback that, we're seeing pretty much everywhere.
Did they say where specifically they felt the pinch?
They did get quite specific, actually. They pointed to softness, particularly in lower-end buffet traffic.
Buffets. Interesting.
Yeah, their theory was it might be linked to certain regional factors. Markets with a big agricultural presence may be feeling more economic uncertainty, or potentially shifts related to immigration affecting that workforce and customer base. Quite a granular observation.
Okay, so acknowledging that softening, that complexity, how did they adjust their outlook for the full year? Did they get cautious?
They did. They definitely dialed back expectations, citing those near-term headwinds and also just normal Q3 seasonality. The forecast for the full year 2025 is now for lower single-digit revenue growth. I think somewhere around 2%, maybe 2.5%.
2.5% growth.
Yeah, it's basically them saying, look, our internal engine is revving up, but the overall economic road is looking a bit bumpy for the next few quarters. Very prudent guidance, you could say.
But even with that short-term caution, they didn't back off their longer-term goals, did they? Which really underscores how much faith they're putting in these internal self-help initiatives.
Absolutely. They reiterated two major targets for the next 3 to 5 years. First, a big organic growth number, $200 to $300 million.
Wow. Where does that come from?
Primarily from that cross-selling opportunity we just talked about, leveraging the new capacity, especially in Atlanta, to sell more products to existing customers. And second, the really crucial one for investors, hitting a 5% adjusted EBITDA margin within that same 3 to 5 year window.
That 5% target, that feels like the whole story right there.
It really is. Achieving that hinges almost entirely on those ERP efficiencies and operational improvements flowing through to the bottom line consistently.
And M&A is still part of the picture too, right?
Acquisitions.
Still a core pillar, yes. But they're emphasizing tuck-in deals right now, buying smaller, often first-generation family-run operators.
Why those specifically?
The idea is minimal integration hassle, easier to absorb, and potential for quick synergistic margin improvements by bringing them onto HF Foods' platform and scale, expand density in markets they're already in. They did touch on thinking about their capital structure, needing flexibility for both these capacity projects, which they expect to fund from cash flow mostly, and maybe larger M&A down the line.
Okay, which brings us perfectly to the stock's reaction, because it was weird. Great results, beat expectations, stock pops 3.4% after hours, and then over the next month or so, it trends down significantly, like over 15% down. What happened? Why that disconnect? It's a classic case of operations reporting an A+ weight, but finance dropping, well, maybe not a bomb, but certainly a surprise.
Yeah.
The pressure came almost entirely from a separate announcement they made around the same time. A new $100 million at the market equity program. An ATM.
Ah, the ATM. So the market saw potential dilution?
Bingo. The market interpreted this plan for capital flexibility as a sign they might issue more shares, diluting existing shareholders. So the stock got punished purely for management, giving themselves the option to raise equity capital if needed.
That's tough. Reward the great quarter or punish the potential future dilution. How did management try to counter that skepticism?
They moved fast. Very soon after announcing the ATM, they announced a deal to use that flexibility. They agreed to acquire a distribution facility in Chicago.
Using the ATM firepower right away.
Exactly. Framing it immediately as, see, we need this flexibility for smart, accretive growth. This Chicago deal was positioned as both a cost-saving move and a way to expand capacity in a key market. A direct attempt to show the ATM was for offense, not defense.
Okay, so pulling this all together, what's the bottom line for the investment thesis here? What should people be watching?
It all comes down to execution. Plain and simple. Can management successfully deliver and, crucially, show the market the cost savings and efficiencies from that ERP system? They absolutely have to prove that those internal gains are real, quantifiable, and strong enough to hit that 5% long-term EBITDA margin target. That's what will eventually, hopefully, offset the market's current worries about near-term traffic softness and that ATM dilution overhang.
So the main things to watch are
ERP savings actually hitting the P&L, the cadence of any potential acquisitions using that ATM flexibility, and of course, keeping an eye on those external factors like tariffs, especially the potential for rising ones on frozen seafood from places like India.
Right. It's a story where internal control, the efficiency levers they pull, is battling market skepticism and macro headwinds, which actually sets us up perfectly for our final segment, where we step away from the standard analysis and propose a, let's call it, highly aggressive trade idea based purely on what we've discussed. And remember, this is strictly conceptual. This is not financial advice.
Okay, let's get outrageous but plausible. The core thesis here is that the market is laser focused on the short-term negatives, the ATM dilution risk, the Q3 traffic slowdown, and in doing so, it's significantly underappreciating the quantifiable long-term positive impact of the ERP rollout and that $200–300 million cross-selling revenue opportunity.
So you're saying the market's got the balance wrong?
Arguably, yes.
Yeah.
We'd assume for this trade that the stock maybe bumps along sideways or even drifts a bit lower in the near term as those Q3 concerns play out.
Okay, if the hidden value is a long-term margin story, what's the specific bet? How do you play it?
Given that the big P&L lift comes from operational discipline and the key high-volume, high-margin categories benefiting most are meat and poultry and seafood, exactly where the ERP provides the most control. The idea is a highly targeted, long-dated call option spread.
Long-dated calls. Okay, betting on a specific future event then, a catalyst.
Precisely. We are targeting a potential re-rating event, a moment where the market suddenly recognizes the value and the trigger. It's the first official, undeniable, robust quantification of those ERP savings hitting the financial reports.
When would that likely be?
Probably not until they report Q4 2025 results, or maybe even Q1 2026. That gives the system several quarters to run and time for things like the Salesforce rationalization to become clearly visible in the DSA numbers.
So the outrageous part is betting purely on internal efficiency metrics that haven't even been fully reported yet.
That's the guts of it. Betting that when those efficiency numbers are finally clear and undeniable, the market will abruptly realize that the 5% long-term margin goal is actually credible, and that realization will overpower the current fears about dilution and temporary traffic dips.
Yeah.
You're betting the operational reality eventually trumps the financing structure fear.
Fascinating. A very specific internal catalyst-driven trade. Okay, let's recap quickly. HF Foods Q2. A solid beat, good execution on pricing and volume, but the narrative instantly pivoted to, can they prove the ERP system delivers the necessary long-term efficiencies, especially while facing market skepticism from that ATM program and some macro softness?
Which leaves us with a final thought for you, the listener, to chew on. Management guided to pretty low single-digit revenue growth for this year, right? Around 2 to 2.5%. Given that fairly flat demand picture, how quickly do those ERP savings need to show up tangibly, quantifiably in the P&L to convince a skeptical market that the 5% EBITDA margin target is actually achievable in that 3 to 5 year window? Especially if that Asian restaurant traffic stays soft into next year.
Efficiency basically has to become the main growth story until the top line fully recovers. A lot riding on that ERP execution. That's our deep dive on HF Foods Group. Thanks for tuning in.